Hey everyone, welcome back to Corporate Decoder, the place where we crack open corporate filings so you don't have to, even if it means sifting through a lot of fancy financial jargon to find the juicy bits, like this recent report from the Federal Home Loan Bank of Dallas. Now, this isn't your typical company that sells a product you can hold in your hand. They're a bank, a bit specialized, and they get their money mainly by selling debt. Think of them as borrowing money from lots of people to then lend it out. What is key here is they're announcing new debt they're committing to issue. This is how they fund themselves, so it is pretty important to see what they're up to. Let us dive straight into the numbers, because that is where the real story is. They're re-showing us a list of bonds they plan to issue. We see a mix of them, each with its own trade date, settlement date, and maturity date. For instance, on the 10th of October 2025, they have a bond with CUSIP 3130B84S8 that is set to mature way out in October 2055. That is a 30-year bond, quite a long time. The amount for this one is $30 million. Then just a few days later, another big commitment on the 14th of October with CUSIP 3130B85B4. This one matures sooner in February 2026, and it is a massive $1 billion. These are significant sums, and it tells us they reactively managing their funding needs. What is really interesting here is the variety in how these bonds are structured. We see fixed rates, but a lot of them are variable, tied to something called SOFR, or Secured Overnight Financing Rate. For example, many of these bonds are single index floater types. Essentially, the interest rate on these bonds will go up and down depending on what SOFR is doing. This is a common way for banks to manage interest rate risk. If they borrow at a variable rate and lend at a variable rate, they can often keep the difference stable. We also see different call types. Some bonds are non-callable, meaning the bank can't pay them back early. Others offer an optional principal redemption, which is essentially a call option for the bank. This allows them to pay back the debt early if interest rates drop significantly, saving them money. Think of it like refinancing a mortgage when rates go down. The call style further specifies how this works, like Bermudan or European calls, which dictate on what specific dates or intervals they can exercise this option. These details are crucial for understanding the bank's flexibility and potential future costs. Now, looking at this table, it presents a snapshot of debt commitments. We see the trade dates, which is when the agreement to issue the debt is made, and then settlement dates, when the actual money changes hands. The maturity dates tell us when the principal has to be paid back. The par amounts are the face values of these bonds. What this all translates to is a clear picture of the bank actively engaging in the debt markets to secure its funding. They are issuing a substantial amount of debt across various maturities and structures, including both fixed and variable rate instruments. And that is it for this filing. The Federal Home Loan Bank of Dallas is clearly busy managing its finances through debt issuance. They're issuing a variety of bonds with different terms and conditions, showing a proactive approach to funding. It is a complex dance of borrowing and lending with structures designed to manage risk in fluctuating interest rate environments. So, what is my take on all this? Well, the Federal Home Loan Bank of Dallas is operating in a predictable way for its business model, which is to borrow and lend using the capital markets. The sheer volume of these commitments indicates a healthy level of activity, suggesting they are meeting their funding needs. The use of variable rate debt, particularly tied to SOFR, is a standard practice. A key risk here, as with any financial institution, is interest rate risk. If SOFR were to rise unexpectedly and dramatically, their borrowing costs could increase, impacting their profitability if they can't pass those costs on to their borrowers. Conversely, if rates fall, they have options to refinance. The report doesn't show any red flags screaming danger, but it does highlight the ongoing management required in the financial sector. Alright, that is our breakdown of the Federal Home Loan Bank of Dallas's latest filing. What is your take on these debt commitments and what they signal for the bank's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.